Joining me now to discuss M&A trends is Matthew Ponsonby, co-head of mergers and acquisitions for EMEA at Barclays Capital. Matthew, thank you so much for coming in. It does seem that actually 2011 is going to be a good deal or a good year for deals. How much does this have to do with the fact that, well, it seems that we're over the worst in terms of, recovery being put in place, and that fuels, in general, M&A?
That's absolutely right. We're clearly going into 2011 with some very significant momentum. I think $130 billion worth of deals announced in the first 3 weeks, which is the highest level since 2000, the last big peak. And that's underpinned by a number of trends, and the first of which is clearly that companies are searching for growth, and they're doing so with strong balance sheets.
And I know you go through your report actually saying that there are fundamental key drivers because of this, and you say, of course, the economy is rebounding, but it's also possibly opportunities in the emerging markets.
Absolutely. As companies are looking for growth, both in the emerging markets and in the rest of the world, they're looking both cross-border, they're looking into new regions, they're looking for new products. And so what you've seen is a huge resurge in cross-border M&A, but also in M&A for cash. So it's companies with strong balance sheets buying growth, and that's being supported by their shareholders.
Is there a particular trend that actually surprised you? I know some of the people that come and speak to us say actually the leveraged buyout is back on the return. Is it something that you're looking at?
Absolutely. If you think about companies looking for growth, the other side of that is the companies are being very rigorous at looking at their allocation of capital. And as they look at the allocation of capital, they're looking at what is non-core and what is core. And as they think about the non-core assets, they're looking to dispose those. So if you combine that with the fact that the financing markets have been robust last year, and there is financing there for the right deal that's structured appropriately, that's good for the financial buyers. They have a ready source of assets, and they have the financing markets to be able to take advantage of it.
But overall valuations aren't particularly cheap.
They're not, but I think as we see confidence coming back from management teams and buyers alike, what you're seeing is if you have confidence, you have visibility on your future earnings. That way the value gap, the perception gap between buyers and sellers as to the future prospects of a target, that gets closer together as they have alignment as to where they think the future's going, and that means the value gap gets smaller.
When you look at a company, one of the worst things they can do, I guess, is not actually capitalize on their growth, but they can also overstretch themselves. Is there a danger that there's a race to become bigger unnecessarily?
That's certainly a concern, but I think if you one of the features of the downturn was that although there was a liquidity squeeze, actually companies came through the downturn with relatively strong balance sheets. So there are a number of big corporates that are long on cash, and they're looking to deploy that cash. So actually, although there is a concern, there is a focus on ensuring that the capital structure of a deal is right. That capital structure, if that capital structure is right, there's support from both the shareholders but also from the providers of debt finance.
But how much is it also fueled by low financing costs? Clearly
it's helpful that absolute financing costs are low at the moment, and companies are taking advantage of that.
Again, is there a danger, Matthew, that actually if we look at it in 1 or 2 years when interest rates are going to be higher, you're going to have a lot of these big companies saying, well, I'm not sure what I've done and I'm not sure if it was the right decision?
It's impossible to know whether decisions are going to be the right decisions, but I think the basis of most transactions that have taken place last year, and as in fact as we look forward to 2011, is strategic deals, companies going for sensible growth, things that are strategically important to them, and most importantly, that those deals are structured appropriately. So the capital structure is right, and if the capital structure is right, that should set a sound base for the prospects of the company going forward.
Matthew, 2011, a bumper year in all quarters, or are we going to see a slump in activity at some point? Difficult to say.
Difficult to say, but I think we certainly go into this year with momentum. I think there's a lot of strategic backlog of deals that need to get done. The financing markets are there. There is confidence. There is this visibility of future prospects, and I think all that adds up to hopefully a sensible year for M&A.
Matthew, thank you so much. Matthew Ponsonby.